Hi everyone, and welcome to our ATAR Notes lecture for today. Today we're covering QCE Accounting, Units 3 and 4. My name is Jess, but before I tell you more about me and go through our content for today, I wanted to tell you a little bit more about ATAR Notes for those of you who don't know us. So ATAR Notes started back in about 2007. We've been doing these free lectures since about 2015. But we do have lots of other free resources for students like you. So I encourage you to go to atarnotes.com and find all of the other things that we have available. So in addition to lectures, we also have online Q&As, videos, articles, ATAR calculators, and study notes. So if you feel like you need more help in accounting or any of your other subjects, then these resources can definitely help you. We also have what we call ATAR Notes Plus, and this has a range of different text guides, study notes that you can use to help you with your subjects. I actually wrote the ATAR Notes Complete Course Notes book for accounting, so that is available for you as well. It goes through all of the syllabus content that you will be taught in Units 3 and 4 and provides some tips and advice and things like that as well. So without further ado, let's get stuck into it. So my name is Jess, as I mentioned. I graduated in 2020 and I'm currently studying communication and journalism at the University of Queensland. So I've just finished my third year of that, and 2024 will be my final year. I love reading and writing, so English and humanities subjects like accounting, business, and legal studies were my favourites at school. In terms of today's lecture schedule, we are going to go through all of the syllabus content for Unit 3, Topic 2. This is likely what is coming up in this coming term for you at school. It does vary depending on the way that your school structures things, but that will be what is expected next for most of you. And you can see down the bottom that we've got a bit of a progress bar that shows you what we'll be up to at each stage. And so you can keep track of that. And underneath the different sections, we'll be looking at describing and explaining. We'll be looking at analyzing and evaluating, and then synthesizing and solving, which are the different requirements for you in accounting. So let's get started. To begin with, we're looking at general purpose financial statements. So you need to be able to describe and explain these sorts of things. So a general purpose financial statement is a statement that's related to the financial branch of accounting. So you've got external reports and you need to follow a range of statutory obligations in terms of reporting. So for businesses that are public companies, so listed on the Australian Stock Exchange, for example, these general purpose financial statements would be published and accessible to the public. So think about a public company like Woolworths or Qantas or any of those companies, and we would be able to access their financial statements since they are public companies. So examples of general purpose financial statements are just the ones that you're familiar with at school from what you would have learnt in accounting already. So the statement of profit or loss, the statement of financial position, and the statement of cash flows as well. Now, classifications are used in statements, and these organize the information. So organizing items into different categories with comparable items. So items that are similar in some way and can be compared. So classifications are going to differ according to the specifics of a business. So factors like size, and the activities of the business and the ownership structure are going to impact that. So, for example, if you have a really huge organization, it's likely going to have more sort of elements, more things that need to be subdivided into other different categories, whereas a small sole trader business would be a lot more simple in its operations and wouldn't need as many different classifications. And activities as well, as we'll see, depending on whether it's a trading business or a service business, that's also going to impact the headings that are used. So let's zoom in now on the statement of profit or loss. So this statement classifies both revenues and expenses. And you can see a standard classification is here on the screen. So underneath revenues, you've got sales or service fees, and you've got other as well. This template can be modified to suit specific business types. So service fees is only going to apply to service businesses because they're generating that revenue from the services that they provide. And then sales will only apply to trading businesses. However, you do have overlap here when it comes to businesses that both offer services and sell goods. So both classifications would be necessary in that case. So for example, think about hairdressers. Oftentimes when you go to a hairdresser, not only do they provide the service of cutting your hair, but they also have different products that they may sell behind the counter, like hairbrushes and different hair products too. So some additional classifications that could be used by businesses include miscellaneous items, dispensing fees, and commission revenue as well. So for example, with commission revenue, if it is a real estate business and the organization has some kind of revenue system where you receive a commission for certain sales of something. And also further subdivision can occur within the categories as well. So sales could be subdivided according to the source of the sales. And that would probably occur in, like I said earlier, a bigger business where you need to organize things out more. In terms of expenses, a standard classification is here as well. You've got selling expenses, administrative, and finance. So again, this template can also be adapted to suit different businesses. So an additional classification for cost of sales would be necessary for a trading business because it would cost the business money to get the inventories in order to then sell them. Usually a service business is not going to have that category. However, it could have another category for the cost of the services. So maybe it has costs that it incurs in order to deliver those services. And some other possible categories, you could have occupancy expenses or promotion expenses as well. And so here is a bit of an outline of those three key kind of categories that you'll need to know for accounting at the year 12 level. So in terms of selling expenses, it's anything associated with promotion, selling, and distribution. So advertising, sales salaries, sales commissions, delivery vehicle expenses and depreciation on a delivery vehicle, for example, because that is distribution related. Administrative expenses is about operating the office and other sort of general expenses that go into a business functioning. So office wages, telephone, insurance, rates, those sorts of things. And finance expenses are associated with funding the business's activities or collecting cash. So you've got interest on loans, you've got bank charges, bad debts, and credit card charges. So if we then look at these next to each other with the service industries and the trading industries, so you can see the service has service in the revenue section, whereas the trading has the sales, and then the expenses section is the same, except you've got cost of sales for a trading business. So if we see this in practice, then we can have a look at this statement of profit or loss and what it looks like. So for example, in the expenses section, you've got selling expenses to start with. We've got advertising, delivery vehicle, sales commission, and sales salaries. We've got administrative expenses with electricity, insurance, office salaries, and then finance expenses, we've got some bank charges, interest expense, and credit card fees. So you can see how it makes it a lot easier instead of having this huge long list that is hard to absorb and hard to understand. Dividing it up to make it a bit neater is what this classification system provides in the way of benefits. Now let's have a look at the statement of financial position. So this classifies assets and liabilities. Now current assets are retained for less than 1 year, and non-current assets are retained for more than 1 year. And these are usually separated when it comes to classifying in our financial position statement. So some examples of primary current assets are cash, accounts receivable, inventories, and then our balance day adjustments with prepaid expenses and accrued revenues. You can see our common classification here, current assets and non-current assets. You can also have additional subdivisions within non-current assets because there's lots of different types. So other financial assets, property, plant and equipment, intangibles as well. So let's have a look at those three categories. We have other financial assets, which are items expected to be retained for more than 1 year to generate revenue. So bonds, shares, anything that is another investment that's going to generate revenue, hopefully. Property, plant, and equipment. So this is about those physical things that you have. So furniture, vehicles, land, buildings. Intangible assets are then the opposite. So they're not tangible. You can't touch them. So you have things like copyright, goodwill, patents, franchises, those sorts of things that can't be touched but still have that monetary kind of value. So like assets, liabilities are classified based on time. So again, current liabilities, they're paid within 1 year. Non-current liabilities are debts that are going to last for more than 1 year, and they are separated from one another. So some common current liabilities, there's more of these than there are non-current. So bank overdraft, where you are in debt, you don't have any cash at bank, you've got an overdraft where you owe the bank money. Accounts payable, GST clearing, short-term loans, and then our balance day adjustments of accrued expenses and unearned revenues. And then non-current liabilities are basically those longer-term loans that you may have. Now, owner's equity is the other section that we find in our statement of financial position, and it's typically displayed in more detail than strictly necessary to illustrate how the capital account has changed during the accounting year. So instead of simply listing that final balance for the capital account, it has the opening balance at the start. You then have the profits generated during the year that are added. Then you subtract losses or drawings, and then you list that final result to show that whole process. And you'll see here in this example, which we'll look at shortly, that we've got 180,000. That was our opening balance. We've added that net profit, and then we've found the result of that. So 224,000 is what we've got by adding that, and then we subtract the drawings in this case, and we get that final figure. So this statement can be formatted in different ways, and that is going to impact the classifications that are used. And so the statement of financial position can be in narrative form without working capital, narrative form with working capital, and in account form as well. So let's go through each of these as well. It's important that you are aware of these different types because you may be asked in your assessment pieces to take on different forms. It's always handy as well if you're able to do it yourself, and that will then help you to be analyzing, even if it's given to you as a stimulus piece. If you're familiar with the layout and how it all works, that's going to help you analyze it too. So first of all, narrative form without working capital. So when we think of this narrative form, it's I suppose it's longer. You're displaying it all out in more of a fashion that it's only sort of one column going down. We'll see the comparison to the account form shortly, where it's more horizontally based. So without working capital involves having all of your assets listed first, current assets, and then non-current assets. And then liabilities are separate with current and then non-current before you have the owner's equity at the end. On the other hand, when you do have working capital, you start off with current assets, which is the same, but then you go straight to subtracting current liabilities. So instead of having all of the assets to begin with and then the liabilities, you're focusing on what is current and then what is non-current. So once you've got the that subtracted figure, so current assets less current liabilities, you can see at the top of that second screenshot on the right, you've got the working capital figure. And then you continue on with those non-current assets and liabilities, and the owner's equity section remains the same. And account form, you can see more of a horizontal structure in that you've got the things next to each other. So current assets here is on the left and current liabilities on the right, with the owner's equity at the bottom there. And you've got your figures that are matching up on each side. You can see those total values at the bottom. Okay, so comparative financial statements. This is about comparing a particular financial statement with the equivalent statements from previous accounting periods. So these comparative financial statements do this by displaying the current year's figures alongside the figures from previous years. So you might have seen this in stimulus you may have gotten before, or other sort of examples you may have looked at. So financial reports are often consolidated into one column per year to make this analysis a lot easier, because then you're able to analyze the differences between the different years based on dollar amounts, so how much it's actually different in terms of a dollar monetary value, and then also percentage differences as well. So you could say it's gone up or down by 10%, 20%, etc. Over the year or over however many years it is. So this is an example from a QCE sample exam for the external exam. And so we've got the 2020 figures right next to the 2019 figures. They've been consolidated into one column for each year. We've got the accounts on the side, and the figures in brackets represent the negative kind of values. So yeah, you can see how it enables that easy comparison between the years since they're right next to each other like that. So according to the syllabus, you need to be able to describe a few different accounting concepts and principles that underpin the preparation of these financial statements that we've been talking about. So accounting concepts that you need to know include the accounting period concept and the accounting entity concept. And then the principles that you need to know include the monetary principle, the going concern principle, and the historical cost principle. Okay, so starting with the accounting period concept. So this says that the life of a business is separated into arbitrary time periods. So these are typically one financial year. And this allows periodic reporting regarding the business's performance to be completed. So we always talk about the different years in accounting. So we are separating the life of the business into all of those different financial years. We just looked at those comparative financial statements. You had 2019 versus 2020. So separating out what is happening in the business, the results of the business, into those different years to allow for that periodic reporting that is done with those financial statements at the end of each financial year on the 30th of June. The accounting entity concept, this separates the business owner and their personal financial affairs from the business. So in terms of accounting purposes, they don't want your personal life to be intermixed with your business life, because that entity concept, it's a separate business. It's a separate thing. So the owner's private financial information is not going to be on the business's accounting records. And under this concept, all of the transactions must be recorded from the business's perspective. It can't be anything to do with the owner and looking at it from their personal perspective. The monetary principle, and so this stipulates that all transactions are documented in the common monetary unit in use. So this one's pretty straightforward, because we know that in Australia we've got dollars and cents. So the transactions can't be expressed as a monetary value from a different currency, and transactions can't be expressed. If they can't be expressed, then they can't be included in financial reports. you've got to have that dollar value to attribute to the account. Otherwise, you can't include it in a report like that. It's not comparable to the other values then. The historical cost principle. So under this principle, a business's assets are recorded in the statement of financial position at their historical cost. And this means it's the amount the business paid for the assets when they bought them. So this ensures that the values contained in the business's records are objective and verifiable. So they don't want the business to sort of make up values to skew the look of the financial statement. They don't want the business to show that their assets are far more valuable than they really are, because that would then misinform people who would then need to use those financial statements. So, for example, a business could manipulate investors by suggesting that in its records that its assets are far more valuable than they really are, and then maybe investors would be tricked into believing that the business is performing better than it really is. And so that historical cost is verifiable. You can look at the records and see when they purchased it and for how much, and there's no subjectivity there, no bias possible. And lastly, the going concern principle. So this is the assumption that a business will continue to operate indefinitely with little likelihood of it being liquidated in the foreseeable future. So when you're generating financial statements, this principle helps because the values given to accounts in these financial statements are based on this idea that the business will continue to operate. So if the assumption didn't exist, then the value of a business's assets may be a lot less, because if it's likely that the business would end and be liquidated, then its assets would need to be sold quickly, probably at discounted prices, and would therefore not be deemed as valuable. So this idea is assuming that the business is going to keep on operating. So you've got this standard way that all of the assets are going to be treated like they would be worth their full amount. Balance day adjustments. This is something that is hugely important in Year 12 accounting. You may have already learnt about this in Year 11, but it's important to get on top of it if you don't feel like you are already, because there's more to it that will come up shortly as well. So these are entries that are made on balance day, so the 30th of June at the end of the financial year, to match the revenues and expenses correctly, which allows the profit to be found. So these adjustments also bring into account assets and liabilities that were not documented earlier in the financial year. And so these are all necessary when the business is using a accrual accounting system. So 7 balance day adjustments that you'll need to be familiar with are prepaid expenses, accrued revenues, accrued expenses, unearned revenues, accumulated depreciation, provision for doubtful debts, and inventory adjustment. So let's go through some of these in more depth. So a bad debt is an outstanding balance of an accounts receivable, which is unlikely to be recovered from by a business. So when you offer credit to customers, that means that they can pay using their credit line, so they don't have the cash to give you then and there. And then bad debts are when those customers then can't ever give you that money. So it can be an individual or an organization, and they're not going to pay that debt. So that becomes a bad debt, aptly named. Now, doubtful debts is when you're thinking that it's uncertain whether those debts will be paid to the business. So provision for doubtful debts is accounting for that. So it's the projected amount of bad debts that will stem from those unpaid accounts receivables. You are putting in a provision, so sort of making that allowance for what is likely to happen. And the provision for doubtful debts decreases the accounts receivable figure in the statement of financial position because it is what we call a negative asset account. And we'll have a look at what those are later on in this session as well. So if you're thinking that you're not going to receive these payments, then you're reflecting that by decreasing that accounts receivable to show that it's not as high as it otherwise would be. Something that's important for you to know in year 12, both now and moving forward as well in your external exam and your other pieces of assessment, are the ratios. So you need to be able to calculate ratios, understand what each of the ratios is, and also be able to analyze and evaluate as well. Because you could be given scenarios where you're given industry benchmarks and then the ratios for the business at hand as well. And you would potentially be asked to analyze the business situation, provide recommendations, make decisions, those sorts of things. So having a really solid understanding of all of your ratios is important. You'll be introduced to further ratios as you go throughout the year, but for now we're looking at profitability and liquidity in particular. So profitability ratios, as the name suggests, measure a business's performance in terms of generating those earnings, that revenue. So the capacity of a business to use its resources to maximize its profits. Some examples of profitability ratios include the net profit ratio, gross profit ratio, and then return on owner's equity and return on total assets. So let's look at these in turn and think about what a high and low ratio means for each. So the net profit ratio is looking at a business's ability to produce a net profit from each dollar of sales. And so you calculate this by dividing net profit by net sales. And typically you can multiply it by 100. So the result can be expressed as that percentage. And so keep in mind when it comes to ratios that you'll be given formulas in your exams. So you'll have a formula sheet that will help you in that way. However, there are different nuances that necessitate that you actually understand the calculations yourself without solely relying on this idea of a sheet that's given to you with formulas. Sometimes, in order to find the amount that's listed on the formula, you need to do calculations first. So make sure that you get yourself familiar with each of the ratios and how they're calculated and the ins and outs of that. So when it comes to a high net profit ratio, that indicates that a business has adequate revenue and is minimizing expenses. So a high ratio here is what you want. A low ratio suggests that a business's selling margin and volume of sales are too low and expenses are too high. So a business could improve its net profit ratio by trying to increase sales and reduce expenses. So if you were to look at this in a scenario case, needing to make suggestions and recommendations, you could be pointing out that increasing sales is necessary, and you could make specific suggestions. For example, maybe the business needs to do some kind of marketing campaign or advertising campaign to generate those further sales. And to reduce expenses, perhaps you could suggest that the business seeks different suppliers that are more affordable, or it chooses different providers for different things. So maybe it's got a really expensive telephone plan, or a really expensive rent, or electricity prices and things like that. So depending on the stimulus that you're given, the information that you're given on the business, you need to pick out what different changes could be made, what the recommendations are that you would give to improve the business's situation. You'll often find that the information that you're given in an accounting year 12 context is the business will need to improve in some way, because you're going to be asked to give recommendations. So it's unlikely that you're going to be given information about a business that's already performing well above the expected standard. Next up is the gross profit ratio. So it expresses a business's gross profit for each dollar of net sales, and it signifies a trading business's capacity to produce a gross profit from its sales and the margin of profit on hand to cover its expenses. So you divide the gross profit by net sales to calculate this. And again, you can also multiply the figure by 100 to then have that percentage result. So a high gross profit ratio indicates that the business can cover its expenses without any trouble and is able to earn a satisfactory net profit and return on investment. So again, a high gross profit is best here. So on the other hand, a low gross profit ratio is going to suggest that the business will struggle to cover its expenses, and a net loss and insufficient return on investment may arise. So some potential strategies: you could increase selling prices and decrease the cost of goods sold. And that could potentially be achieved by sourcing a more affordable supplier. So the return on owner's equity ratio represents the business's ability to generate a return to the owners on the capital invested in the form of profit from sales. So you divide net profit by the average owner's equity to find this. Now, when we say average owner's equity, this will involve you looking at the owner's equity from the 2 different years. So say it's 2022 and 2023, and you'll be adding those and dividing by 2 to find the average. And again, you can multiply by 100 to express the result as a percentage. Now, a high ratio suggests that the owner made a good decision to invest, and the business is being managed effectively and efficiently. But at the same time, if you have a high ratio, it could be a bad thing as well. So it's possible that the business may be undercapitalized. So it may not have enough investment behind it. And that is why the ratio is so high. A low ratio suggests that a business is not generating a satisfactory level of profit per dollar invested by the owner. It also could indicate that the business is highly capitalized and cautiously operated or managed inefficiently. So depending on what the result is, whether it's high or low, the owner may want to increase or decrease their capital investment to address under or over capitalization. And then increasing the profit, the net profit, is another strategy that can improve this as well. Of course, the net profit is something that's part of that calculation. So changing that is going to improve it if you increase it. Return on total assets. This is our last profitability ratio for now. So this measures how effective a business's assets are in generating a profit. So it's all very well having a whole bunch of assets, but if they're not actually valuable to a business, then that isn't going to be very effective, really, from a financial point of view. So you can add together the net profit and interest expense and divide the result by average total assets. Again, those average figures are always made up by adding the previous year and the current year's figures and dividing by 2 to find that average. Now, a high return on total assets indicates that the business's assets have performed well and have been used effectively to generate profit, but a low ratio suggests the opposite. So you can improve this by increasing net profit and reducing the average total assets. So if you've got lots of assets that aren't generating a profit, selling those can help. That can generate some money for the business then, and it can also then reduce those assets that aren't providing that profit. So think about, for example, if you've got a car hire company, they've got lots of assets, lots of cars to hire out, and perhaps there are some old models of cars that the business still owns that no one wants to rent out. And so the business has them still listed as assets, but they're really not very valuable to the business. It would be in their interests to look at selling those assets. It could get some money for them to put it in a better financial position in that way. And it would reduce those assets on its books, and that would help improve this return on total assets figure. The other aspect you need to know about for now is the liquidity ratios. So later on in the year, you'll look at stability ratios as well, and then some ratios that are specific to public companies. That doesn't come until the end of year 12. But for now, so liquidity ratios are going to communicate a business's capacity to meet short-term financial commitments. So when you think about the statement of financial position, we list our current assets and we do so in order of liquidity. So if you've got cash in hand, so physical cash, that is very liquid because it's right there. You can literally give it to someone to pay off a debt or to pay for something, to purchase something. And then next up would be cash at bank. You've got money in a bank account that you could use. And then something that's less liquid is accounts receivables because you're relying on other people to pay you back before you then get that money in order to pay your own financial commitments. So this idea of liquidity is about how easy it is to turn the money into cash that can be used to immediately pay for something. So some liquidity ratios include the current ratio, the quick ratio, and then the rate of turnover of accounts receivable and the rate of turnover of inventories. So let's now look at each of these. So the current ratio indicates the business's ability to meet its short-term financial obligations. So short-term financial obligations are defined as debts due in the present financial year. And it's measuring this in terms of using its current assets in order to meet these obligations. So you'd calculate it by dividing current assets by current liabilities, and it's expressed in this ratio form. So a number with a colon and another number. So the number 1 is on the right side of the colon, and the quick ratio calculation for the business is on the left side. And the benchmark is typically greater than 2:1 for the current ratio. But keep in mind that benchmarks can be really different depending on the industry, because the business's activities, again, are going to really influence what is deemed standard for that industry. The quick ratio, so it's also called the acid test, and it measures the capacity of a business to fulfill its immediate financial responsibilities, so things like accounts payable, using the assets that are available really on hand, either instantly available, so they're right there, again, like cash in hand or cash at bank. The business already has that money that they can use, or quickly converted assets. So, for example, accounts receivable has to be converted. The business has to get that money from the accounts receivables before it can then use it. So it's calculated by subtracting inventories and prepayments from current assets and dividing the result by current less liabilities less any bank overdraft. You're not always going to have a bank overdraft, but if there is one, it's important to subtract that as part of your calculation. Keep in mind as well with the formula sheets that you get, sometimes little nuances like that are not included. So that is something that you may need to just know, because it's very, it's rare that there's a bank overdraft. So that could be something that you just need to memorize yourself. Keep that in mind. So again, this is expressed in ratio form, again with that number 1. And in this case, the benchmark is typically greater than 1:1. So a high quick ratio is going to indicate that the business's current liabilities can be paid out of its current assets. So that's what you want. A high ratio is better. A low ratio is going to suggest that the business is relying on inventory turnover to pay short-term debts. So it's relying on selling its products in order to pay those short-term things. So it's a less stable position to be in, because if sales were to take a downturn and you weren't generating as much turnover of inventories, then you wouldn't be able to pay those short-term obligations. And of course, that would not be a good position to be in. So of course, that means that you want to decrease current liabilities, and increasing current assets would improve this ratio. So there's a whole bunch of suggestions that can come as part of this to improve those things. So if you want to improve your improve your accounts receivable. Maybe you want to, in order to address bad debts and things like that, maybe you want to offer some incentives for people to pay early or on time. You could seek out some discounts for paying your obligations early, and that can help as well. In terms of turnover of accounts receivable, this is showing the average collection time it takes for accounts receivables to reimburse the business with the money that they're owed. So it measures the efficiency of the business's accounts receivable management practices. Now you calculate it by dividing net credit sales by the average accounts receivable. So of course it's about credit sales here, is it's accounts receivable, not cash sales. So this rate can be expressed in times or days. So the number of times that accounts receivables are paying in a period, or the number of days it takes to for each accounts receivable to reimburse the business. If you've got the rate for times and you want to convert it to days, you can divide the times figure into 365. So 365 divided by the times figure. Now, a high rate of turnover of accounts receivable, so a low number of days, indicates that the business's credit policy is effective. If you've got a low rate, then of course it's the opposite. It says that the business has a poor credit policy and may be at risk of having a high amount of bad debts, of people not paying off their debts to the business. So if you've got it in times, then you want the number to be higher. If you've got it in days, then you want it to be lower. So a wide range of strategies can be used to improve this ratio. So it could improve its credit policy, contact outstanding debtors. So you could perhaps hire someone to phone, email, or send letters to the people who owe the business money, to try and follow up and prevent the debts from turning bad. It could more sort of strictly assess the creditworthiness of customers before offering credit to them to begin with. And it could also offer incentives for early payments, like I mentioned before, and charge interest for late payments. So you've got that reward for early payments, and I guess a punishment of sorts for late payments, trying to incentivize those on-time payments. Now, turnover of inventories, so a similar idea, except in terms of inventories instead of accounts receivables. So the management efficiency of a business in terms of its inventories, how fast the inventory is sold, and the liquidity of that inventory. So you calculate this by dividing the cost of goods sold by average inventories. And this is something where you're not always given the cost of goods sold results. If you're looking at financial statements, trying to find the figures to plug into your formula, this is something where you need to understand how to calculate it. So the rate can be expressed again in times or days, and it's that same process in order to convert it from times to days. So a high turnover of inventories, so a higher number of times or a small number of days suggests the business's inventory is fast moving, or there could be a lack of inventory for sale. So this is a little bit double-sided where in general, you probably are going to assume that this rate would be good because the inventory is moving fast. But you also do need to consider that idea that maybe there's just not enough inventory to begin with. So it's not moving fast or slow, it's just not there, which isn't a good thing because it suggests that maybe the business hasn't got very good systems with stock takes, understanding supply and demand, and things like that. So a low rate indicates, on the other hand, that the business has potentially slow-moving inventory, or it has a large quantity of inventory on hand waiting to be sold, which is a problem because you want things to be moving quickly. You want to be making use of your storage space for things that are going to generate money quickly. If you've got things in storage that aren't being sold for a long period of time, then that is wasting your asset of your warehouse where things are stored. And it's also particularly problematic when you've got things that can go obsolete or can spoil, like food can spoil. So a low inventory turnover for that is problematic. And things can go obsolete as well. So that means that it's no longer the latest thing, it's outdated. So if you think of a phone, there's lots of new phones that are released every year. So if you've got phones from years ago still in stock, then they may have become obsolete because they're outdated and new, better things have been produced. So there's a few ways that you can improve this. So you want to promote some higher inventory sales. You want to potentially discount the sale of those slow-moving inventory items so you can get them out of stock. Make sure that you don't buy them in future if they aren't going to sell quickly enough. And you also want to maintain the stock of those popular items so you can meet the demand that's there for that. There are some limitations of the financial statements, and so we're going to go through those now. The first ones we'll look at are for the statement of profit or loss. This has some overlap with the statement of financial position as well, though. So the first one, results vary depending on the systems that the business uses. So when it comes to things like inventory values, like the cost of goods sold and inventory adjustment, those figures vary according to the system and the valuation techniques that the business uses. So this sort of inconsistency can be a limitation. Typically, businesses are going to use the lower of cost and net realizable value framework to value their inventories. And this can produce lower inventory records and show smaller profit figures than a more consistent valuation method. So that can be a limitation. It's also pretty complex to calculate cost and net realizable value. So this can then cause discrepancies. Cost can be construed in a few different ways. You've got the first in, first out, or FIFO, or FIFO. You've got the weighted average cost, specific identifiable cost, or standard cost. You may not be familiar with those last two, but hopefully the first two are familiar. And each of these ways of calculating costs is going to generate different figures for inventory, cost of goods sold, and profit. So this can be a limitation in terms of being able to compare with other businesses, being able to understand what this business actually is showing. So it can really vary depending on the systems that they use. Another sort of calculation issue is that there is a need to actually estimate some figures. So, for example, depreciation, you need to estimate the life of an asset and the residual value, and that can impact the accuracy and consistency of depreciation figures that are listed in the statement. And there's also different depreciation methods as well, and they can yield those really different depreciation figures depending on what the business does use. And businesses also have to do other estimation as well. So we were talking about doubtful debts. They have to estimate what they expect to not receive from their accounts receivables. And then this has flow-on impacts. So the quantity of bad and doubtful debts expense that's recorded in the statement of profit or loss, and then that again has a flow-on to the overall profit figure as well. Some other ones. Now, price changes. So the value of money changes over time. So the purchasing power of money, and that results in different periods not being able to be compared. So, for example, if we think of the impact of COVID-19, it would be pretty tricky for businesses to be comparing 2019 to 2020 because of the impact of COVID on the economy. It would also be tricky to compare from, say, 15 years ago when there was like the global financial crisis in that period, and comparing that to a later period where the economy is more stable. That is difficult to do because of those differences in that purchasing power of money and the situation that the economy is in. So inflation, which you probably know about from the cost of living crisis recently, causes the present day profit of, say, 10 million to not be equal to the 10 million profit from 10 years ago. You know what I'm talking about, revolves around current revenues, current costs, so things like wages, and out-of-date costs being intermixed. And so again, that idea of different things from different periods being mixed together, and those things may not really be comparable because they're from those different periods. And then finally, possible manipulation. So a business can manipulate its financial management practices to cause the statements to be inaccurate in some way, to misrepresent the actual performance. So if you think of companies where managers may earn more money based on the performance of the business, they may be inclined to then misrepresent how well the business has done to try and get extra benefits and bonuses because of this supposed strong performance. So there is that room for manipulation there. In terms of the statement of financial position, you've got some of the same limitations again. So price changes again, estimated figures that you'll need for that statement as well. There are a few other limitations. So a common misconception around the statement of financial position is that it signals the value of a business and its net assets. So it's not as straightforward as that, because assets are typically listed, like we spoke about earlier, at historical cost rather than their current selling value. So for example, if you purchased a building 10 years ago, then it is listed at that price that you paid for it all that time ago. But with the property market, it's probably gone up in value, but that is not reflected on the statement necessarily. So for anyone who's hoping to use the statement as a value statement, it's actually got limited usefulness in terms of that. Now, the guidelines for handling intangible assets are inconsistent. So the intangible assets figure in the statement of financial position is not necessarily representative of the asset's actual value to the business. So, for example, goodwill is not necessarily recorded. It may be recorded if it has a definitive cost, so what it's actually worth, but oftentimes it's not recorded at all. And similarly, things like trademarks, they are often not included, even though they are part of the business's assets. And then the accuracy and usefulness can be limited by things, just small quantities of consumable items being omitted from the statement. So stationery, stamps, fuel, those things can all add up to be to have some value, but they're often not going to be included in these statements because they're more minor than other things. And this follows this idea of those items would be written off as expenses. So that's why they wouldn't be included, because stationery is just one of those things that you've got to pay for some basic things, and it's not really seen as an asset. Okay, so characteristics of financial information. So there's several qualitative characteristics that guide the preparation of general purpose financial statements, like our profit or loss, financial position, and cash flows statements. So these are the attributes of financial information that are most valuable to decision-making individuals who depend on the business's financial statements to make those decisions. So we've got relevance, including materiality, which is what we just saw then, reliability, comparability, and understandability. So let's go through each of these in turn. So to start with, relevance. So financial information that can make a difference to the user's decisions is relevant. So the influence may be in a capacity that's confirming something or helping to predict something. So it may corroborate pre-existing information to confirm that it's correct, or it could assist the business to predict, or someone else to predict the future outcomes that can inform future decision making. So decision making in terms of what will happen to the business, what investors would do, those sorts of things. And part of this is materiality. So this revolves around certain information's significance to a specific business. So it's intertwined with this idea of relevance. If information being excluded or misreported could affect the financial decisions of users who base their choices off these reports, then that information is deemed to be material. So if it's significant to those people who use the information, then it's material. So what is or is not considered to be material is going to differ between each business, because it's a relative concept. It's not just standard for every business. Immaterial information could be left out from published reports, but it can't be left out at the expense of the accuracy of your accounting entries. So a real world example of this idea of omitting information is the idea that we round to the nearest dollar and remove cent values in some reports. So reliability, this is about, it's important that information is impartial, so it can't be full of errors, it can't be misleading in any way, because it's most useful when it is complete, so there's nothing missing, it's neutral, so no sort of biases have influenced the way it's presented or what's included, and it's as accurate as possible as well. So in terms of comparability, information that is comparable is presented in a way that enables comparison between the business's current financial reports and previous financial reports. And it also involves external comparison. So internal comparison is when you're able to compare that same business over multiple years with different periods. And then external comparison is going to involve assessing the business's financial information against other businesses or industry averages or benchmarks. So consistency in the way information is measured and displayed is really key to comparability, because if it's inconsistent, then you can't compare it. So in science, back maybe in your junior years of science at high school, you probably did different experiments where you were only allowed to change one variable and things like that. So we understand that idea that you need consistency in order to compare things, because if you, in those cases in science, if you changed a bunch of different variables, then you wouldn't know which variable had an impact. If the result changed, then you wouldn't know what actually caused that change. So consistency is key to being able to compare. Understandability is pretty straightforward. So information needs to be displayed in the most understandable way possible. In saying that, it's not able to compromise relevance or reliability. Those are sort of the priorities, and then understandability is next. So in order to achieve this idea of understandability, you want to classify and present information clearly and concisely, and then also avoid oversimplification and inaccuracy. So yes, you want it to be straightforward, but you can't oversimplify things, because that would misrepresent the information and jeopardize that reliability as well. So the classifications that we looked at earlier are part of this idea of understandability. It's separating things out to make it easier to read and understand. Just like the way that we have headings in reports that we write, in these slides we've got headings. It's all about making it easier to digest and follow. So I mentioned earlier that we would be looking at asset and negative asset accounts. So that's what we're up to now. Now, the syllabus asks that you need to be able to explain the relationship between asset and negative asset accounts, specifically accounts receivable and provision for doubtful debts. So negative assets accounts differ from the standard asset accounts because they have a credit balance. So we know our assets have a debit balance by nature. Negative asset accounts have a credit balance by nature. So asset accounts are offset by their respective negative asset accounts to determine the asset's net balance. Now, the provision for doubtful debts account is a negative asset account with a credit balance, which reduces the accounts receivable figure listed in the statement of financial position. And this ensures that the statement accurately documents the net realizable value of a business's accounts receivable. So like I said earlier, it's unlikely that the business will receive the reimbursement for those debts, and this is being reflected in the information to show that it's not going to be realized. So those assets are not actually going to produce anything for the business. So it's reducing that accounts receivable to reflect that. You also need to be able to explain the relationship between your different statements. So understanding how they relate to each other is important. Now, the statement of profit or loss, profit or loss figure in that statement links with the capital section of the statement of financial position. We saw earlier how we have the add net profit section, and that net profit figure is coming from the statement of profit or loss. And of course, that impacts the amount of equity that's listed at the end of the statement. So we've got a bit of a visualization here. So you've got the statement of financial position at the beginning of the accounting period. You add the profit or the loss, and you get the statement of profit or loss. You've got the movement of cash in and out of the business during the year, and then you've got the statement of financial position at the end of the accounting period. Something else that you need to be able to understand and then perform yourself is horizontal analysis and ratio analysis. So later on in the year, you'll learn some other types of analysis as well. There's also trend analysis, but for now, these are the two that you need to understand. So horizontal analysis involves analyzing the connections between a financial statement's individual results or collections of results for consecutive accounting periods. So if you think of this idea of horizontal, and you're looking across the years. So that idea we spoke about earlier, how a year's results are consolidated into one column. You're thinking about that in this case, and it's horizontal because we're comparing the different columns across the different years. So horizontal analysis is focusing on one line item of the financial statements. So you're choosing one account, one thing to focus on, with the goal of calculating the percentage or the numerical increase or decrease that occurred. So maybe if you look at the cash sales, then you could be thinking about how that has increased in terms of that monetary value, and then how much it increased or decreased in terms of a percentage as well. In terms of ratio analysis, this perhaps is more familiar to you because we've looked at some of those ratios already for profitability and liquidity. It's likely that you've already been introduced to some of the ratios already. And ratio analysis is just involving analyzing the connections between items or sets of items in the business's financial statements, and it's taking that form of ratios. So these ratios can be weighed against one another as time goes on, to reveal different trends, and it can be used to compare one business or industry to another, and it can also be used to analyze a business against industry benchmarks. So there's commonly those three categories for ratios. We've looked at two of them, profitability and liquidity, and then the final one I mentioned earlier is financial stability. So something that you need to be able to do as part of the evaluating section of this unit is to evaluate for a trading GST business, so one that is trading goods, selling goods, the effectiveness of accounting practices to make decisions and propose recommendations regarding monitoring business performance and liquidity. So I've put together a bunch of examples of things that you could be looking at. So as I mentioned earlier, you're generally going to be given information about businesses that have different problems that you need to try and pick up on, because you're not going to be able to make recommendations and decisions about a business that is doing as well as it possibly could be doing. So potentially an issue that you could have that comes across in the stimulus that you're given could be maybe high cost of goods sold and high sales returns. So you could be suggesting in the points that you make and the decisions and the recommendations that you give, you could suggest that they find a more affordable supplier. They could survey customers to learn why customers are returning their purchases, and they could also source higher quality products. Potentially quality could be the issue with the cause of sales returns. Maybe the sales returns are not about quality and they're about people having bought something that wasn't what they expected it to be. So maybe the labeling or the marketing around things is not clear enough. Stagnant inventories. So I mentioned earlier, it's really important to have that turnover of inventory, particularly when you've got inventories that could spoil or become obsolete. So you could be suggesting that the business sells those stagnant inventories at discounted rates to make room for stock that's going to generate the revenue. They want to make the most use of the space that they've got to store inventories. And then, of course, you also would suggest avoid purchasing those poor selling inventories in the future. Maybe they need to better plan for their stock. Maybe they need to have more of some things and less of others. Maybe they need to introduce whole new lines of inventories and get rid of whole lines of other inventories. If the business has an inventory shortage, then there's lots of possibilities with this. You could be suggesting, if they don't already know, you could suggest that they investigate the cause of the shortage. Of course, that's the number one thing they would want to do. Improve record keeping. That could be a problem if the records aren't being kept up to date enough, and so they weren't aware of shortages at an earlier time. Increasing the frequency of stock takes can make them aware of any discrepancies earlier. If there could be supplier issues as well if there's an inventory shortage, so checking records to make sure that suppliers delivered the correct quantity of goods to begin with, ensuring that the ordering was done correctly with the quantity that was ordered to begin with. And if it's likely that inventories were stolen, you could suggest that they implement measures to try and prevent that in future. So CCTV cameras and alarms as well. If the business has paper records, then you would definitely want to suggest that they digitize those records. That's going to decrease expenses and increase efficiency. You're not going to have to pay people to wade through paper records of things, which is of course going to take a lot longer and therefore be more expensive. You could also suggest training employees to ensure that they understand how to use digital systems if that is a gap that is part of the scenario. If you've got high, bad, and doubtful debts, you could be suggesting reviewing the credit policy, checking creditworthiness, charging interest, offering discounts, and hiring someone to follow up on debts to prevent them from going bad. Those things that we spoke about earlier as well. So oftentimes you're going to have a little bit more information than what's here. So for the inventory shortage, you'll probably have more of an indication of the ins and outs of that for the business in the scenario you've got, but making sure that you consider a whole range of possibilities in the points that you make and reflecting that in your recommendations as well. So this is an example that you can access from the QCEA. They have subject reports that they produce after each year, and so this is in one of their subject reports, and you can access it at the link there on the screen. You can see here how a student has written about proposed changes as part of their evaluation, and this is an example of a really strong evaluation. So they are identifying the different things that are happening in the business, and then they're making suggestions based on that. They're making sure that they justify things along the way as well. So for all of these things, I encourage you to keep the slides and read through things in your own time, at your own pace, to absorb everything. And you can also pause the video as well to make sure that you're getting everything fully. In terms of prepaid expenses, so we're now up to looking at balance day adjustments, and we listed those earlier. So prepaid expenses is one of them. It's an asset. So these are expenses that arise from a business making payments in advance. So they will pay in the current accounting period, but they won't get the goods or the services that they're paying for until the next accounting period. So to record a prepaid expense, one of the following general journal entries would be necessary, and it depends on whether the prepaid expense is increasing or decreasing. So in the first one, we've got a debit to the expense account and a credit to prepaid expenses, and the other one is the opposite. So let's go through what decreasing would look like. So here is an extract of a business's trial balance and the necessary balance day adjustment. So we've got $400 debit for the prepaid insurance account. The adjustment is insurance paid in advance is $250. So the amount of prepaid insurance is decreasing by $150 because the original trial balance shows it to be $400, but it's found that it's actually supposed to be $250 as per the adjustment. So we know that prepaid expenses is an asset, so it has to have that debit nature, and that means that to decrease an account with a debit nature, the account is credited. So the general journal entry would be the credit to prepaid expense and the debit to insurance to reflect that. And it's the difference between the results as well. So it's 150 because that is the amount that it's decreasing by. Now this balance day adjustment would create an insurance account, and that would appear in the statement of profit or loss. and the balance would be $150 again because the account was debited in the previous balance day adjustment. So that would be how it would appear as an administrative expense. And in terms of the statement of financial position, the prepaid insurance would be $250 because, as we saw in the adjustment, that's what the value was supposed to be. Accrued expenses. So these are expenses that are incurred in the current accounting period but are yet to be paid. So accrued expenses are current liabilities, and wages and salaries are common examples of these. So to record an accrued expense balance day adjustment, you need to have a debit to the expense account involved and a credit to accrued expenses. So this general journal entry is going to increase the expense account to the correct amount, and then it's going to create an accrued expenses liability account because the amount of the adjustment is owed on balance day. So that accrued expense liability account is then listed in the current liabilities on the statement of financial position. Unearned revenues. So when a business receives revenue in the current accounting period that it will not actually earn until the following accounting period, this is called unearned revenue. So if, for example, a business owns property that it might lease out to another business, then maybe the owner of that other business has paid rent in advance. So the business is getting this revenue, this rent revenue, even though it hasn't earned it yet. So to record an unearned revenue balance day adjustment, you need to have a debit to revenue and a credit to unearned revenue. So it's decreasing the whatever revenue account it is to ensure that it's representative of the amount that was actually earned in the period. Because any additional money that wasn't earned would belong in the next accounting period. It also creates that unearned revenue liability account because the amount in the adjustment is owed on balance day. So that again goes to the statement of financial position in the current liability section. And lastly, accrued revenue, which is an asset. So revenues that are yet to be received but have been earned already in the current accounting period. So the opposite to unearned revenue. And to record this, it is a debit to accrued revenue and a credit to the revenue account in question. So this increases the relevant revenue account to the correct amount, and then it creates that accrued revenue asset to represent that the business is owed money on balance day. And that is included in the statement of profit or loss. You need to know about bad debts and the processes around these. So you need to know how to write off a bad debt and the process for that. So it involves a bunch of steps, which we'll go through now. First of all, you do the writing off of the bad debt. So this is recognizing that those debts that are deemed bad will not be received. So you're reflecting that in your accounting records. You do a debit to the bad and doubtful debts account because this account is increasing. It's an expense account, so that's debit by nature. It's increasing and therefore it's debited. And the accounts receivable account is credited because this asset account is decreasing. You were supposed to get that money from that accounts receivable, but it's decreasing because you're writing it off. You're saying we're not going to get this anymore. And if GST is applicable in the case that you're working with, then it would be GST collected, so it would be debited. The next step is at the end of the accounting period. You would, so it's always going to be the 30th of June in our accounting system. Transfer the bad and doubtful debts account figure to the provision for doubtful debts account. So this is going to offset the bad debts that arose in the accounting period against that provision for doubtful debts account, because that account was initially created to provide for these debts. So you're now offsetting that provision that you had. So the provision for doubtful debts account is debited because this negative asset account is decreasing. Remember that a negative asset account is a credit by nature. So to decrease it, we then need to debit it. The bad and doubtful debts account is credited because this expense account is decreasing. The necessary balance day adjustment is listed there on the screen. So this idea of offsetting is reducing the balance in each of these accounts to nil. Step 3, so at the end of the accounting period, again, this is all June 30, you need to determine the new balance in the provision for doubtful debts account and record this balance in a balance day adjustment entry. So the necessary balance day adjustment is a debit to bad and doubtful debts and a credit to provision for doubtful debts. So we just had this previous step, which was the opposite, and now at the conclusion of the period, we are determining the new balance. We've offset the previous one and we're determining the new one. Then we're closing off the bad and doubtful debts expense account in step 4, and the necessary adjustment is that debit to profit or loss summary and the credit to bad and doubtful debts. So what is the provision for doubtful debts figure? So it's the sum of the business's current accounts receivables that are expected to turn bad in the next accounting period, and any under provision or over provision stemming from the bad debts that arose during that accounting period. So what is under and over provision? So an under provision is when the opening balance of the provision for doubtful debts account at the start of the period is less than the bad debts that arose during the period. So you have under predicted, I suppose, that the bad debts are more than what you predicted at the start. And then the over provision is just the opposite, which is better in a sense because you expected it to be worse. You had the provision for doubtful debts as higher than the doubtful debts that actually arose. So that's good because it turned out better than what you expected and what you accounted for. So let's have a look at an example of an under provision. So we've got this business and it's got an accounts receivable control account that had $200,000. The desirable amount of the provision is 4% of this accounts receivable figure. During the year, bad debts written off amounted to $33,000, including GST. And the business had a provision for doubtful debts figure of $10,000. So using this information, we want to generate our different accounting entries. So the formula for an under provision that it's important that you know is bad and doubtful debts excluding GST. So if the figures that you are given include GST, then you need to make sure you remove that. So bad and doubtful debts less the opening balance of the provision for doubtful debts account, and then add the desirable provision. So let's have a look then at how we find these values. So the first step, of course, is to look at those values in the formula and find what they are. So the bad and doubtful debts figure is $30,000. We know that because in the information we were given, it was 33,000 including GST, and we needed to figure out what it was without GST. So we divided by 11 and it came out as 30. The opening balance of the provision is provided in the question. That was $10,000. The desirable provision is $8,000, and we figured that out by looking at the information we were given. It's supposed to be 4% of the accounts receivable figure, which was $200,000. So 4% of that is $8,000. We then substitute the values into the formula on the previous slide. 30,000 less 10,000 plus 8,000 is 28,000. So we can see the different steps here according to those steps that I listed out before. So first of all, with step 1, we are accounting for those writing off those bad debts. And you can see in this case, we've got that GST figure. Next off, we're transferring the bad debts to the provision for doubtful debts account with the $30,000 figure. And then we've got our new balance that we've figured out. So this is the adjustment to ensure that we're reflecting that provision that's meant to be 4%. So that's in step 3. And finally, you then have that same figure to close it off for the profit or loss summary. And so in the profit or loss, you're going to have that $28,000. And then in the statement of financial position, it will have you've got the accounts receivable control figure that we had to begin with, given in the question, $200,000. And then we worked out that the provision for doubtful debts was $8,000, and that is listed there in that statement. Now let's have a look at an over provision. So on the 30th of June, Toys Galore's accounts receivable control, again, $200,000. And again, we've got 4% of accounts receivable, but during the year, bad debts written off amounted to $7,000. And the provision for doubtful debts had a $10,000 balance. So we can see this is an over provision because that provision for doubtful debts account is more than what the debts actually were. 10,000 is more than 7,000. So we've overestimated what our bad debts would be. So the formula for this is different. So we start off with the desirable provision, and then we are taking away the opening balance of provision for doubtful debts less the bad and doubtful debts. So let's have a look at what this looks like. So the value provided in the question for bad and doubtful debts was 7,000, including GST. We need to remove the GST amount. We know the opening balance was 10,000 provided in the question. The desirable provision, again, 8,000, that same calculation from the previous one. The only change here is the bad and doubtful debts amount that changed to 7,000. The other figures in this are the same as the other example. And then, of course, we've got those substitutions into the formula. Make sure that you've got your brackets with that there, and you work it out accordingly, and it's 4,000. And then this is then recorded, that same process as before, where you first of all need to write off the bad debts, then you transfer the bad debts to the provision, and then you include the entries for the new estimated amounts that you've just worked out. So next up, aside from working out writing off bad debts, you also need to know what to do with when you're recovering bad debts. So this scenario is going to show the process of recording bad debts that are recovered in a different accounting period from which they were written off. So you've written them off in a previous accounting period, and maybe years later, someone then pays off their bad debts. So in this case, in 2020, a business received a check from a previous accounts receivable, and it had already been written off years earlier, and it had included GST. So the situation here is they are they have already written it off, so it was already nil, and the entry for the receipt of cash would be reducing that accounts receivable. However, the ledger would then show that the business is in credit because you've already written off those previous debts, and so now it's suggesting that the business actually owes that creditor money because you're adding that 396 in this case on. So because you've got this credit balance, which suggests that the business owes P Watts money, you need to have an additional entry. So this is the bad debts recovered entry. So you increase the accounts receivable again to reflect that it was owed to the business, and then you have the bad debts recovered and GST accounts. So the account must indicate that money is owed to the business. So we're increasing that asset account. When the bad debts were written off, the GST collected account was debited to cancel the GST that was owed. But now that the debt has been recovered, the GST must be collected again. So that's why the GST collected account is credited to increase that liability. And the bad debts recovered is a revenue account, and that's increasing in this case because you're getting something that you hadn't already gotten. Now, if a bad debt is recovered in the same period, it would be a different process. The entry that originally wrote off the bad debt would just be reversed. So if in 2019 an accounts receivable called W. Jones had been written off as bad and the account had no GST, then the entry would have been what's on the screen there. And then if in that same period, so May 2020, if you assume that the 30th of June is the end of the period, the debt was recovered, then the entry would just be the exact opposite as the previous one. So in terms of interest on overdue accounts, so you could charge customers interest if their accounts are overdue, or a supplier could charge the business interest on their own accounts. So in terms of a customer's account, you've got the accounts receivable debited and the interest revenue credited. So you're increasing the accounts receivable because you're then going to be owed more money with the interest that you're adding on to what was already owed. And the interest revenue account is credited because the revenue account is also increasing, and revenue is a credit by nature. So to increase it, you credit it. GST does not affect interest, so that's why it's not a factor here. Now, the general journal entry for being charged interest by a supplier is interest expense is increasing because you have to pay more of that. It's a debit account that is going up. And the accounts payable is also going up because you're going to owe more money. And that's a credit account that's increasing, which is why it's credited. Inventory adjustment. Now, this is another balance day adjustment, and to record a shortage, you are increasing inventory adjustment and decreasing the control account for inventories. So, of course, inventories are an asset. An asset is a debit by nature. So, to decrease an asset, you credit it. So, that's why here we are crediting inventories to recognize that our asset is going down. And the general journal entry to report the gain is the exact opposite of that. And the inventory adjustment account for an inventory shortage is going to appear in the statement of profit or loss beneath the cost of goods sold. So you can see here how we've got those figures there. You subtract that and get the result as well to help you calculate the gross profit. So finally, we're going to have a look at your accounting IA2 with what to expect there. So it's an exam that's separated into 3 parts. You've got part A with some short response items. Now this consists of 2 questions that require paragraph responses of between 50 to 100 words each. And you need to demonstrate comprehension of concepts, principles, or processes in the context of fully classified financial statement reporting for a trading GST business. So all of the content that we looked at in the describing and explaining section, where, for example, you need to understand the limitations of financial statements, the qualitative characteristics that guide the way that they are reported. These sorts of things are the things that you could be assessed on in this Part A section, your understanding and your ability to describe and explain them. Part B is a practical item. So it's one practical item that means that you need to synthesize and solve a goal-orientated problem relating to fully classified financial statement reporting again. So you're going to have unseen stimulus that you won't have seen prior to the exam. And I encourage you to go to page 38 of the syllabus for more information about the practical item. You'll see some information that it gives around what the stimulus could involve and what the question could involve. And part C is your extended response item, one question requiring a business report extract response between 400 to 500 words. It will involve seen stimulus that will be provided 5 days before the exam. And you need to analyze and interpret financial data and information that will focus on either profitability or liquidity. And students must evaluate accounting practices to make decisions and propose recommendations to improve profitability and liquidity. So the question that you're given is more than likely going to encompass both, and you need to be providing recommendations and decisions about one that you choose out of profitability or liquidity. So this is an example question that not something that you would necessarily be asked to do in an exam because it's quite detailed and all-encompassing. But this is giving you an opportunity to have a practice with some of the things that we've covered today. So we've got a trial balance and a list of adjustments to be carried out. So this is giving you the opportunity to have a go at recording the necessary balance day adjustment general journal entries, create an adjusted trial balance. So the adjusted trial balance just has those additional account values that would have popped up in those balance day adjustments and the different values for the existing accounts. Then you would also prepare a fully classified statement of profit or loss and statement of financial position. And again, we looked at earlier how you can lay out these statements in different ways. So the statement of financial position can be narrative or account form and with or without working capital. I encourage you to have a go at different ones. So for me, I was very familiar with narrative form, particularly without working capital. And if that is you, then perhaps you want to have a practice with account form to make sure that you're familiar with that as well, and vice versa as well if your situation is the other way around. So just some final tips with some memorization strategies for those things that we've covered today. Pairs are assets is something that is really, really helpful, or it has been for me throughout my my history doing accounting. So pairs stands for prepaid expenses and accrued revenues, two of our balance day adjustments. So if you remember that pairs are assets and you remember that the other two accounts are the accrued expenses and the unearned revenues, you can use that process of elimination to know that those other two must be liabilities. In terms of GST, if it's included, so it is included, then you need to divide by 11. If it's not included, you need to divide by 10 in order to calculate the GST component. So earlier we had figures in our under and over provision examples where the GST was included, and we divided by 11 because of that. So if it wasn't included and we needed to calculate GST, we would divide by 10. So I remember this by is included is like I, so it looks like 11. Is not included, you've got the is again, but then you've got the O in not to make up that 10 instead. Also to remember that drawings are debited or a debit, you've got the DR in drawings, which of course is that abbreviation for debit. So some general tips as well. I did not make use of the QCEA's resources until very late on in the piece. So I recommend that you go to the QCEA website and access what's available to you. You've got example assignments, past exam papers for the externals, different reports that are done for the subject each year that are predominantly aimed at teachers to give feedback on things like how they make the assignments and write the questions, but they can provide some great insights for you as well. Use the syllabus as a study guide. So this whole lecture is based on the syllabus content that you are asked to do. So if you can go through that yourself and understand it all, you can use it as that study guide to help you know where the gaps are. Make sure you use accounting terminology and an appropriate tone of voice. So something that students often do in accounting is they're a little bit too emotional in their language. So try not to make everything doom and gloom in the way that you write in accounting. It's that sort of formal kind of language. You wouldn't be describing how devastating something is and how awful it is. You need to describe if it's a poor situation for a business to be in, but using words that are not as crisis kind of orientated. Thank you everyone for coming along today. I hope that you found this lecture useful. And I definitely encourage you to go out and have a look at all of ATAR Notes resources. We've got the accounting notes that I wrote for accounting units 3 and 4 for QCE. So go out there if you want to have some more help and access those. And good luck with the rest of your studies. Thanks, everyone.